Hi, Shane Bevilacqua here from Professional Liability Insurance Group, and today I just want to talk to you a little bit about the difference between having shared limits, separate limits, or defense-only limits for your corporation when it comes to your malpractice insurance policy. Shared limits you can think of as basically your entity, your corporation, sharing in the limits that you have as an individual physician or physicians within your group. So in other words, if you have a $1 million per occurrence, $3 million aggregate policy, and you were to be sued, and your entity was to be named in that suit, then both you and your entity would share the $1 million per occurrence for that particular lawsuit. The difference between that and separate limits is that with separate limits, as the name suggests, you would have a separate $1 million/$3 million policy for your corporation. So in essence, both you and your corporation each have $1 million to defend you, as well as pay any indemnity payout that is applicable to either yourself or the corporation. Now, there is a company that has what's called defense-only limits, or offers defense-only. Defense-only limits, as the name suggests, only defend your corporation in the case that it's named in a lawsuit along with you. But if there is any indemnity payout, any monies that are to be paid on behalf of that corporation as part of the result of that case, they would not be covered by that particular type of insurance, and you would be held liable for that payment, or your corporation, so to speak. So the difference between shared limits, separate limits, and defense-only limits is pretty obvious now. But what I want to share with you also is the number one question we usually get from every one of our practices, physician practices, and that is whether or not they should pay for separate limits, because the difference in premium between shared limits and separate limits is that shared limits, there's no charge at all. Separate limits, you do have to pay a charge, and typically most companies will charge you anywhere between 10% and 12% of the premiums or rate that the individual physicians are paying in that group. So the more physicians you have, the higher the premium will be for your corporation for separate limits. And you might say, well, why do I have to pay so much if I have a larger group versus a smaller group? And the answer is basically that each physician in your practice could potentially incur a claim, and when they do, that entity will also be named in that claim. So there are more ways for that corporation to be brought into a claim, and so therefore the higher premium for separate limits. My gut check for most physician practices is that if you only have one or two doctors in your practice, you're probably okay with shared limits. No charge. The entity shares in the limits with you and your partner in your practice or your employee, and you should be covered for most claims sufficiently depending on your specialty. Of course, higher risk specialties, you may want to have separate limits regardless. Separate limits typically is better to be utilized when you have a larger group. Imagine a group of 30, 40, or 50 physicians and the number of times in just 1 year that particular entity could be brought into a claim. So in those situations, we strongly suggest that you get separate limits for your corporation with the larger groups. So there you have it. Today, shared limits, separate limits, and the occasional carrier that may offer defense-only limits, the differences between the three, and I hope that helped today.